Let us sit down and look at some numbers that are quietly rewriting the rules of the global financial system tonight. The world of central banking just experienced a significant structural shift that will directly impact our capital over the next decade. The United States Senate has officially confirmed Kevin Warsh as the 17th chairman of the Federal Reserve. Now, you know me, I do not care for political theater, and I completely refuse the industry of financial sensationalism. But when the leadership changes at the most powerful central bank in the world, we owe it to our portfolios to look at the cold math. I remember when I first started tracking monetary policy in my early 20s, I used to think the game was about guessing the next rate cut. I thought I could outsmart the market by chasing short-term momentum, which was really just an illusion before the market taught me about real risk. The truth is much more boring. It is simply about understanding historical patterns and staying completely unemotional when the crowd panics. Let us look at what is actually happening behind the headlines regarding the relationship between the White House and the central bank. The executive branch has consistently expressed a desire for deep interest rate reductions, aiming for target levels near 1%. Lower rates make mortgages cheaper, contract corporate borrowing costs, and allow the government to refinance its massive debt burden. Currently, the domestic national debt has expanded to nearly $39 trillion, and the net interest on that debt is the fastest growing national expense. To a president, lower interest rates are the ultimate economic accelerant because they pump liquidity directly into asset valuations and equities. But the role of the Federal Reserve is fundamentally different from the objectives of an election cycle. The central bank is structurally designed to balance economic expansion with the preservation of currency, purchasing power if a central bank blindly prints money and cuts borrowing costs during an inflationary period. It risks destroying the value of the dollar entirely. During his confirmation hearings, Kevin Warsh explicitly stated to the Senate that he would remain an independent actor and not a political tool. This creates an immediate structural tension because the market must now calculate whether the Fed will prioritize the economy or the dollar. Let us look at the mathematical reality of the inflation metrics we are facing in this specific period of 2026. Consumer price inflation is currently reporting a year-over-year increase of 3.8%. Which remains stubbornly above the official target. More importantly, producer price inflation, which measures the wholesale manufacturing costs before they hit retail shelves, is running at 6%. When wholesale costs remain elevated for this long, corporations eventually pass those expenses directly down to consumers. This inflationary pressure has been compounded by geopolitical disruptions in the Middle East, which pushed global oil benchmarks higher. When energy costs rise, those costs flow mechanically through every single layer of the supply chain, from shipping to grocery retail. Right now, this 2026 inflation wave is officially outpricing general wage growth, meaning the average person is losing purchasing power every single day. If the Federal Reserve chooses to stimulate the economy right now by dropping rates, it will act like pouring fuel onto a kitchen fire. Asset owners will watch their stock portfolios rise on paper, but the underlying purchasing power of those dollars will melt away. Kevin Warsh has dropped signals about a potential regime change in the conduct of monetary policy, and we need to analyze what that means. Historically, during his previous tenure as a Fed governor from 2006 to 2011, he established a reputation as an inflation hawk. During the Great Financial Crisis of 2008, he frequently voiced internal skepticism about the long-term consequences of quantitative easing. He warned that massive balance sheet expansion and artificial liquidity injections would create structural distortions and threaten currency stability. Now that he takes the chair, he inherits a central bank balance sheet that stands at an unprecedented $6.7 trillion. His public comments suggest he intends to shrink this balance sheet aggressively, reduce forward guidance, and host fewer press conferences. By reducing the verbal noise and shrinking the money supply, he wants to return the market to a state where capital is priced by fundamental risk. But we must remember that the chairman of the Federal Reserve does not possess unilateral authority to dictate interest rate policy. Monetary decisions require a majority vote among the 12 voting members of the Federal Open Market Committee. This is where the dynamic becomes mathematically fascinating because the former chairman Jerome Powell is not leaving the building. Although his term as chair expired, his structural term as a Federal Reserve governor continues all the way until 2028. Jerome Powell has indicated he intends to retain his voting seat on the board while a previous administrative investigation concludes. This means the committee remains deeply divided, with multiple policymakers signaling that future rate increases are just as likely as rate cuts. The market is currently pricing in a 97% probability that rates will remain completely unchanged at the upcoming June meeting. So, how do we look at this transition as a generation trying to build and preserve durable wealth? When I managed to accumulate my first $100,000, it was not through guessing macro policy or betting on central bank decisions. It was through a completely unglamorous process of maximizing my savings rate, avoiding lifestyle inflation, and trusting the math of compounding. If you are waiting for a central bank rate cut to bail out a poor investment or to justify a speculative asset, You're playing a losing game in a world where free money is officially dead. The market naturally shifts away from rewarding financial engineering. It returns to a framework that rewards fundamental productivity, clean balance sheets, and positive free cash flow when the risk-free rate remains elevated. Every business must prove it can generate actual profits without relying on cheap debt refinancing. I used to look at aggressive market rallies and feel a massive sense of missing out, thinking I needed to take bigger risks to keep up. But after calculating the mathematical reality of a major capital loss, my entire approach to risk management shifted permanently. If you permit your portfolio to drop 50% because you chased a high-leverage narrative, you require a full 100% return just to get back to zero. When you understand that simple geometric reality, you stop looking for overnight multi-baggers, you start looking for boring, consistent, defensive compounders that allow you to ignore the daily market fluctuations entirely. Let us look at our personal capital allocation through the cold lens of opportunity cost under this new Federal Reserve leadership. When interest rates were near zero, holding cash felt like an absolute penalty because inflation was quietly eroding your base. Today, utilizing short-term treasury instruments or high-yield cash accounts allows you to capture a clean return while maintaining maximum flexibility. This liquidity provides you with an option value, meaning you have the dry powder ready to deploy when a premier asset experiences a forced liquidation. You do not have to force an unstable trade today because your capital is actively working for you while you wait for real valuation alignment. This approach requires a massive amount of internal discipline because the media will constantly tell you that you are being left behind. But the numbers do not possess emotions, and the long-term historical data always favors the investor who prioritizes capital preservation. We must also take a highly critical look at how we manage our personal liabilities during this structural transition. If you are carrying any form of variable debt, such as consumer credit cards or short-term lines of credit, that interest expense is compounding against you. Paying off a liability that carries an elevated interest rate provides an absolute risk-free return equal to that exact rate before we even begin to think about maximizing our equity returns. We must ensure our personal balance sheet is completely free of structural leaks. I used to assume that carrying a minor amount of leverage was fine as long as my equity investments were moving higher, but that was a dangerous assumption built on the illusion of a perpetual bull market, and a mature risk framework removes that vulnerability entirely. Let us keep a close eye on the macro calendar for the 16th of June and the 17th of June, which will mark the first official policy meeting chaired by Kevin Warsh. During this meeting, the central bank will release its updated summary of economic projections and its interest rate plot. This data will reveal exactly how many committee members believe that interest rates must stay higher for longer to combat the 2026 inflation reality. We should observe these announcements not as a signal to trade actively, but as a laboratory to watch how institutional capital reallocates itself. The more you observe these macro cycles without emotional attachment, the more you realize the short-term market is simply a massive voting machine. Over the long horizon, however, it functions strictly as a weighing machine, measuring real economic utility and actual underlying cash flows. Our objective is to ensure our capital is positioned entirely on the side of the weighing machine, anchored by logic and mathematical necessity. Let us audit our current asset allocation tonight to make sure it aligns perfectly with our true personal holding timeline. If you have capital that you will need to utilize for a significant life event over the next 24 months, that capital has no business being exposed to index volatility, with short-term yields offering an authentic return. The capital can sit safely in risk-free instruments, preserving your upcoming plans. Only capital with a timeline stretching well beyond 5 to 10 years should be navigating the price fluctuations of the equity markets. By segmenting your wealth according to clear time horizons, you remove the immediate psychological pressure of daily price charts. You can watch a red screen without experiencing a racing heartbeat because you know your immediate stability is fully collateralized. This is the ultimate secret to remaining calm when the surrounding media enters a state of perpetual panic. I want to encourage you to take an hour this weekend to write down your personal investment policy statement, define your exact target asset allocation, specify your maximum leverage limits, and outline your rules for compounding during expansionary phases. Having a written framework prevents you from making impulsive choices in the middle of a market correction. It acts as your personal anchor when the financial waves become choppy and the noise becomes entirely deafening. The optimal time to prepare for a storm is always when the sun is shining and the parameters of the environment are relatively stable. Once the downpour begins, the human brain enters a state of emotional survival, making logical decisions mathematically impossible. Let us use this quiet period to build our knowledge base, refine our target watch lists, and trust the compounding nature of patience. Take excellent care of your capital, protect your compounding timeline, and I will speak with you very soon.